All right, accounts receivable. One of the great challenges of dealing with accounts receivable is trying to match up uncollectible accounts, the expense of the uncollectible accounts, with the period in which credit sales are made. But somehow we have to try to do it each and every year. And so this is a prediction, this is an estimate, and as such is imperfect. But regardless, we've got to try to match an uncollectible expense in the year of sale. And this is a once a year, end of year type prediction. And so we use an uncollectible allowance account called allowance for doubtful accounts, and so that's called a contra asset account, and we put it on our books, and in this case what they've done at the end of the year, which I guess is January 31st, is decided that they have a $10,000 worth of uncollectible accounts. And we'll talk about what method they use here in a little bit. They're recording this estimate of what they believe will be the amount of uncollectible accounts. And so at the end of the period, they simply debit uncollectible accounts expense. Other people use the term bad debt expense. You'll see that a lot. Uncollectible accounts expense, not so much. And as it points out here, that's a selling expense. It reduces our sales profit. And here you're crediting this contra asset account, allowance for doubtful accounts. And so where you'll see that again is in your balance sheet presentation. You'll have the gross amount of ending accounts receivable, and that amount will be reduced by this allowance for doubtful accounts. So it'll have the gross amount, and then it'll say less allowance for doubtful accounts, and then you'll see the net realizable value of or the book value of the accounts receivable on the balance sheet. And so the net realizable value is the amount of accounts receivable that the business expects to collect. Now note, in our entry, we didn't list any particular account. We just picked a number based upon our analysis of what we believed would be the amount of uncollectible receivables. But the point here is you are going to have particular customers not pay. So this is what happens when you determine a particular account is uncollectible. It's going to be written off your books. And so you've already expensed this, in this case, in the previous period. So the expense already occurred. in the prior year. And here you've determined a particular account is uncollectible, and so you're going to debit the allowance for doubtful accounts account. That's your contra asset account. That reduces the amount of, or the balance of the allowance for doubtful accounts account by $4,000. It was $10,000. We don't know if there was already a balance in there, but let's assume there wasn't. So after this journal entry, you're going to have $6,000 in your allowance for doubtful accounts account. And of course, you're going to reduce by the accounts receivable account, here discount stores, by $4,000. And so that gets it off your receivables. So this is what it looks like before the write-off. This is what it looks like after the write-off on the, in the balance sheet. Notice that the net realizable value doesn't change. Notice that your accounts receivable amount after the write-off has been reduced by $4,000, as has your allowance for doubtful accounts account. But regardless, net realizable value is still at $240,000. They say here at the end of each month, but in large companies like where I worked at, we didn't do this every month. We did this once a year at the end of the year. So I'm going to take some creative license based upon my professional experience and change up the terminology or the wording here. At the end of the year, the fiscal year, management should estimate the probable amount of uncollectible accounts and adjust the allowance for doubtful accounts to this new estimate. So we use two different approaches. We use the balance sheet approach, and we use the income statement approach. I prefer the balance sheet. I think it's more accurate than the income statement approach, but let's look at both and you can decide. So when using the balance sheet approach, what you're going to do is you're going to request from accounting an accounts receivable spreadsheet that's going to list accounts receivable broken down into age classifications. You're going to have the amount of accounts receivable that is considered current, and these are credit transactions, right? So let's say terms are net 30 for this company. So there's going to be certain customers who just sent their bill and 30 days hasn't expired, so that invoice to them would be considered current still. So it would be in the current column of your aging spreadsheet. And let's say now all of a sudden you've got some customers who invoice is 31 days old. Well, that means that they're 1 to 30 days past due. Okay. If they've got 30 days to pay, current up to that 30th day from the invoice, and then from there it moves to the 1 to 30 day past due column in your aging spreadsheet. And so you're going to have current, 1 to 30 days past due, 31 to 60 days past due, 61 to 90 days past due, and you can have over 90 days past due. I would recommend that to at least over 90 days past due so that you can get a good aging breakdown of collectibles. Why is this important? Why do you need this breakdown? Well, it shows that the older a receivable is or gets, the more likely it is that it won't be collected. So the further out you go on the aging receivables aging, the more likelihood that you won't collect it. So basically what you do is you don't look at you can look at the totals in those columns and know that in the current column you're going to collect probably 98%. So there you might want to say, okay, well, I predict 2% of. Okay, you multiply the bottom line figure in current column, let's say it's $1 million, and multiply that by 2, and that's the amount in the current column you predict is uncollectible. All right, so let's move to the next one, next column. Let's see if they do that here. Let's just use their number. Okay, so not due yet, current 51,000. They predict 1% uncollectible. Okay, so that's not unreasonable. Okay, we moved to 1 to 30 days past due. You got total age or total amount in that age group of 29,000. We predict 3% uncollectible. Okay, whatever. Maybe that's based upon experience for this company. And so you take and multiply the total amount in that column, 29,000, times the 3% they deem will be uncollectible. Come up with 870 in this case. Okay, so notice 31 to 60 days past due, 12,000. The balance is going down the further out you go, but the percentage considered uncollectible is going up as it should. So here we predict 10% is uncollectible, so we multiply 12,000 times 10% to come up with 1,200 uncollectible, and on and on and on. And notice this goes out to over 90 days past due. You got 5,000. Luckily not very much past due in the over 90 day column, but look, they're predicting 50% uncollectible. And again, is that 50% based upon experience? Let's hope so. My experience, once it gets over 90 days past due, it's more like 80 or 90% uncollectible, but hey, that's just me in the business. I was in. So once it gets there, chances of collecting get pretty slim. Let's just say that. And so you go through your aging and add up your estimated uncollectible amounts. Here, 5,680 of what's on the balance sheet at year end, this company considers uncollectible. Okay? Now note here what's happening. This company had a prior year balance in their allowance for doubtful accounts account. They had a credit balance of $1,680. Why is that? Well, it could be that they overestimated the amount of uncollectible accounts in the previous year. And so they had this excess 1,680. Like I said, this is not a perfect science. This is an estimate, so it's imperfect. And so because we had a credit balance and we're trying to hit the target 5,680, or excuse me, 4,000, we're simply going to disregard the 1,680 here, because there may be some stuff from previous years that may be in this that's uncollectible. Maybe some of that over 90 stuff is considered in this prior year bad debt expense. You know, if that over 90 column goes 90% uncollectible, you're going to need more than 4,000 in there. So maybe that is factored into this number. So anyway, bottom line is, oh, wait. I got this wrong. Okay, 4,000 is in there at the end of the year. You're trying to get to 5,680. Let's go back. And so 4,000 was in there at the end of the year. And again, what I said was still correct about the previous year, that there's $4,000 that they didn't write off. Okay. And they estimate that they're going to have to write off 5,680, right? And so what may be factored into some of that over 90 bad debt has already been expensed in a previous year in this $4,000 that remains. Okay, so what I said was correct. It's just I had these numbers backwards. And so this is what remained at the end of the year, and you're trying to get to 5,680. So you're simply going to debit uncollectible accounts expense or bad debt expense for the difference, which is 1,680. And of course, 1,680 credit to your allowance for doubtful accounts, which gets the balance in that account, contra asset account, up to 5,680. Okay? Compare that approach, the balance sheet approach, with the income statement approach, which simply takes net credit sales and management estimate of what percentage of those net credit sales will be uncollectible, and then base their journal entry on that calculation. Is it a lot easier than the balance sheet approach? Well, yeah, it's real easy, but I don't know. I don't think it's very accurate. I just think that the income statement, or excuse me, the balance sheet statement, balance sheet approach is a better way of analyzing this. But anyway, some people might use this, some companies might use this. Don't recommend it, but whatever. All right, so here's an example of that. In September, Valley Ranch Supply has credited sales of credit sales of $150,000. Historically, 2% of Valley's credit sales have been uncollectible. For September, the estimate of uncollectible accounts expense is $600. So, anyway. 150,000 times 2% is basically the deal. Here, you're not going to consider what's already in the allowance for doubtful accounts account like you did in the previous example. Here, you're just going to take, this is real simple. Take the amount of net sales, your estimated percentage of uncollectible, whatever that number is, that's what you're going to debit bad debt expense and credit allowance for doubtful accounts. So there's no considering what's already in the account. So pretty simple, huh? Wouldn't worry too much about this, but this is what happens when you write off a receivable previously, and lo and behold, they actually pay you. You've got to restore the receivable on your books and credit the amount collected back to the allowance for doubtful accounts. And then after doing that, you recognize the cash and get rid of the receivable. Direct write-off method is GAAP approved, where we create a bad debt expense and have this contra asset account to come up with our allowance for doubtful accounts to come up with the net realizable value of accounts receivable. Direct write-off method is not GAAP approved, so this is not GAAP. What is direct write-off method? It makes no attempt to match revenues with the expense of uncollectible accounts. Therefore, it violates the matching expense and therefore is not GAAP. When would you use it? Well, if you didn't have very many credit sales. But other than that, you wouldn't use it at all. All right, so that's really all I want to talk about. Really don't want to talk about credit card sales. Let's move on. Notes receivable, unless you're doing a lot of financing, in other words, you're selling product, and let's say you have your own financing arm, you really don't want to use notes receivable for short-term type credit arrangements, because you would have to do so and deal with the paperwork for one of these transactions. Much easier to for recurrent credit sales to simply have them to agree to the terms of your credit sales and establish a credit limit, and then off you go. You got your recourse in the credit arrangement or the credit agreement that they've agreed to. Here you might use this, and I dealt somewhat with Kubota Tractor, and they would sell to family farmers these tractors, and it's a lot of money. And so they would create promissory notes, and the family farmer would sign the note, and of course the note is secured by the tractor. So if they don't pay, Kubota would come pick up the tractor. But anyway, the difference here, it's a little more formal. You have the customer sign a document called a promissory note, and they agree to pay you the principal amount plus a certain amount of interest. Usually the payments are each month, okay? And so the maker is the person who signs the note and thereby promises to pay. The payee is the person to whom payment is to be made. And so a promissory note is an unconditional promise in writing to pay on demand, or usually at a future date, a definite sum of money. And like I say, most of these, it'd be pretty unconventional to do it any other way. Most of these are installment payments. If you made a car payment, signed a note on a car, you know full well what this is about. And so you have the interest component of the payment, and you have a principal component. Well, how do you figure out how to compute interest? Well, it's the principal amount owed times the interest rate times the amount of time involved. Now, accounting books invariably try to make this easy by having what are called balloon payments. In other words, the payment of the principal is done all at once, 6 months or a year later. I mean, this never happens in real life, right? But so you just kind of have to, suspend reality and deal, so you can deal with the accounting issue. All right, so it says here, this time factor, when computing interest for 1 year, time equals 1. When the computation period is less than 1 year, then time is a fraction. And so, for example, 3 months would be 3/12 or 1/4, right? So we have an example here on December 1, a 3-month 6% note receivable is acquired from a customer, Marvin White, in settlement of an existing account receivable, bad idea, of $60,000. What adjusting entry needs to be made on December 31st to accrue the interest earned to date on the notes receivable? So here we have, again, a balloon note. He's going to pay it, at the end of February, basically, of the next year. And so we've got a year end of December 31. We have to account for the accrual of 1 month of interest revenue. And so to calculate that, we take the face amount of the note, $60,000, multiply it by 0.06, which is 6%, times 1/12. And so that calculation produces $300. So at the end of the period, we debit interest receivable and credit interest revenue. And so, okay. March 1 is the maturity date, not February 28th. So anyway, you've got 2 more months of interest you have to deal with in that next year, but apparently you're not going to do it until the payment's made. So 2 months worth of interest is $600 more. Here you didn't book it as a receivable. You're just going to wait till you get paid, apparently, and book it as interest revenue. And so when this payment's made, you book the additional interest revenue for those 2 months of $600. You're going to recognize the payment of $60,900. You're going to reduce the interest receivable by crediting it for $300. You're going to book the additional 2 months interest revenue for $600. And of course, you're going to back out your note receivable by crediting note receivable for $60,000. All right. Anyway, they give you at the end of the chapter some ratios. You might look over those because it provides some analysis skills that you might need in your first job. You never know.